Hi, Kirk. Colin Carter. Spend some time looking at the options pricing sheet from the Wall Street Journal and sort of go through 3 or 4 of these markets and try and understand some of the factors that impact on the price premiums and to come up to speed with some of the lingo with regard to options on futures. So we started on Wednesday with a very brief introduction, and so let's have a look at our handout. And what I've done, I see this light is burned out, but I've written down the prices for some of the corn options. So let's start with corn. So this page is, it's next to all the futures quotes, and let's start with the grain and oilseed sector, which is over in the left-hand side, the first column on the left-hand side. Corn is the first element in that tableau. And what I've done over on the right-hand side, you see I've typed in the underlying futures prices, the settlement prices, because as you know, the options are written on underlying futures contracts. So to understand the relationship between the futures and the options prices, we have to know what the underlying futures are. So the way the exchange reports the prices, you'll see the strike prices down the left-hand side on corn, ranging from 230 up to 280. As with the futures market, they only report some of the contracts that are being traded. They report the most active ones. If you go to the website, you'll find there are more being traded. As I said on Wednesday, that strike price is established by the exchange. So they'll set an array of strike prices, and then the traders in the pit go ahead and buy and sell calls and puts for each particular strike price and for each particular delivery month. So we have a lot of possible contracts here. So we have our various strike prices, and then we have our delivery months. Those are the delivery months on the futures contracts. And you see we're reporting December, March, and May for calls, and December, March, and May for puts. Again, calls are options that give you the right to a long futures position. So you buy a call and you exercise it, you obtain a long futures position at the strike price. And similarly with puts, you're buying the right to go short at the strike price. And these elements in the tableau here are what we call the premiums, and that's the price that the buyer of the option pays to the seller, and it's determined through supply and demand, through an open outcry system during the day, as we saw in the video for futures contracts, and at night it's electronic trading. So those premiums are established by willing sellers and willing buyers, and you know that the sellers or the writers of the option, that's the term we use as the writer, they're embarking in a riskier situation by writing the option, because if you write the option and the market moves against you, you will receive margin calls, and the losses are potentially high, and the profit is limited to the premium. That's the most you can make. Whereas if you buy the option, your loss is limited to the premium. You can't lose more than that, and your profits are potentially high. So the risks are very asymmetric here, unlike with a futures contract where the buyer and seller have symmetric and offsetting risks, right? If the buyer makes $1, the seller loses $1. So let's look at the total value of some of these options, and then we'll talk about the relationship between the size of these premiums. So if we just pick one at random, let's choose this particular option. So that's a call option on December futures with a strike price of $2.30 per bushel. You know that in the case of corn, the size of the contract is 5,000 bushels. So that's 11 cents per bushel times the size of the contract, which is 5,000 bushels. Let's see, what does that work out to? My fingers are bigger than the calculator keys. That's about $500, $562. Okay, so that's the total premium. So if you put in an order to buy a December call at a strike of 230, it would cost you about $562. And again, that's the most you can lose. And the reason that it's relatively cheap is if we look at the December corn futures over on the right-hand side, you'll see that the December settlement price on this same day, which happened to be Wednesday, was 240. Okay, so the strike is relatively close to the underlying futures price. If we take the neighboring option contract, it's even cheaper. It's only 4 cents a bushel. That's with a 240 strike, and that works out to about half the amount of the 11-cent option, so that's only $232 because that strike price is right at the futures contract, and so on. So the price falls, the price of the option falls as the strike price rises because you're buying the right to go long, and when you're buying the right to go long, it's better to go long at a lower price, isn't it, than a higher price. So if you're buying the right to go long at $2.50 and the futures price is $2.40, then that particular option has no intrinsic value. The futures price is below the price at which you would obtain a long position. So you would not exercise that option as long as the futures price stayed below the strike, right? The strike is 250. So you're buying the right to go long at 250. You would only exercise that option if the futures price rose above 250. And it's almost close to expiry. As I mentioned, these options expire before the futures contracts. Many of them expire, some of them even expire the end of November. So there's very little time left between now and the expiry date, and that's another reason that they're less expensive. So if we look, for example, at the March contract, we see we have the same relationship in premiums as the strike increases from 230, 240, 250, the value of the premium falls, again because you're buying the right to go long at on a March contract, and March futures, if you notice over on the right-hand side, March futures are trading at 246. So if you purchased this option, a strike of 240 on the March, and the current futures are 246, then that option actually has some intrinsic value because you're buying the right to go long at 240. The price is now 246. So you could buy that option and actually exercise it, and you get 6 cents back, which is less than what you paid for it. So it wouldn't be a sensible thing to do, but it would if you're approaching expiry and you think that there's no chance for a rise in the price. At least you get some of your premium back. So again, we see that the higher the strike, the lower the premium. But as we move to the right here, we also see that for the same strike, the more distant the month of delivery, the higher the premium, right? So if we hold the strike at 230, then the price goes from 11 cents to 21 and 26 and so on. Now, why do you suppose that is the case? I've explained why the price falls as we go this direction. Yes?
There's more chance for the buyer to make money than the seller to make money. In other words, like there's more time for it to go up.
Exactly. Thank you. If you buy a call option on May futures, well, anything could happen between now and May. There are a lot of potential world events that could affect that market between now and May. Weather problems in Latin America, weather problems in China, all kinds of disruptions in the marketplace. So there's a lot of uncertainty between now and May, especially compared to now and December. where we're almost at the expiry month, so there's a reasonable probability that the price of corn is not going to be at $3 a bushel. But who knows between now and May? So as you said, the writer of the option factors this in. When they're selling the option, they're not on the trading floor to lose money, right? They're trying to make a profit. So when they decide on what premium they want to charge in the trading pit, they look at the strike price. They look at May futures. Okay, so May futures are trading at 250, and then they assess the probability that the price will increase and charge an appropriate premium for that. And the term we use there is time value. That's the time value. So a premium has two components. It has intrinsic value and it has time value. So intrinsic value plus time value is equal to the premium. And I'll come back to this later on in the lecture. But if we look at, we'll just take May corn, for example. The futures price is 250. So if we look at a strike price with 250, then the strike is essentially at the futures price. So if that's the case, if the strike is equal to the futures price, then the futures price is at the money. It's at the money. So in other words, if you exercised an option with a 250 strike, you would receive the futures price at 250. That's where it now is. And if you reversed your futures position, you wouldn't make any profit. So it's at the money. If the futures price moves above 250, then this option would move into the money because you're buying the right to go long at 250. So if it moves above 250, then it would move in the money. The premium on the May call with a 250 strike is 16 cents a bushel. 16 cents a bushel. And if it's at the money, the intrinsic value is 0. The intrinsic value can only be 0 or positive. If it's at the money, there's no intrinsic value. So the 16 cents must be time value. It's completely time value, and that reflects the uncertainty associated with what can happen in the market between now and May. Similarly, if we look at March, March futures are 246, 250 call, so there's a 4-cent difference there. So there's actually a small intrinsic value, about 4 cents a bushel. So here the time value is 7 cents. Here it's 16. So that supports the answer at the back that the premium on May will exceed the premium on March for any given strike because of the added uncertainty associated with time and the time value of the premium. Yes? That's the futures price if you look over on the right-hand side of the page. Okay? This one? Where is it?
Well, the price of corn.
Oh, yeah.
240 to 2,000.
Thank you. I've got an extra decimal in there. The way the Wall Street Journal reports the strike price here, they don't waste any ink on a decimal point. So they write 230, and that's $2.30. And I got a little sloppy over on the right-hand side when I put down the futures price. I meant to put it in the same format and have the decimal move to the right. So it should be, that should be 240 cents, not $240. Thank you. Yes.
So you didn't calculate those futures prices, they came from this sheet, just a different page.
The other part of the Wall Street Journal, yeah. That was the futures price on this particular day, on Wednesday, okay? So let's look at another contract. Unless do you have questions on corn? You're very silent today. Maybe some of the people that ask questions are here. Let's look at crude oil. So crude oil under petroleum, one column to the right, down near the bottom, okay? And there you see the strike ranges from 30.50 up to 3,300. And again, remember they're chintzy when it comes to ink, so you know the price of oil is $30 a barrel approximately, right? So that strike price ranges from $30.50 a barrel up to $33 a barrel. If we look at the December, January, February futures prices over on the right-hand side, you see that Dees is at $31.33 a barrel, January is at $30.89 a barrel, and February is at $30.50. So the market's actually slightly inverted. All the petroleum contracts are at this point in time. So let's choose one of the options, and let's go to the puts this time. So you have crude oil, you have your contract size there, 1,000 barrels, and then you have your strike prices down the left-hand side. Then you have Dees, Jan, February. Again, those are the calls, the first three, and then the second three are the puts. So you have Dees, Jan, February. And if we take $31 strike price, $31 strike, and we choose a February put, which is the right to go short, the price is 1.93, and that's dollars per barrel. And with oil is one of the easiest ones to calculate the value because it's 1,000 barrels per contract. So the premium is equal to $1,930 on the February put, which is the far right-hand column under crude oil. I'm choosing a strike of $31, so that's the second row. And you see the premium is quoted at 1.93. That's dollars per barrel. So if you buy that put option, you're buying the right to go short at $31 a barrel, and you're paying about $2,000 for that right. If we look at February crude right now, it's at $30.50, $30.50 a barrel. So actually a fraction of that premium would be intrinsic value. It would be 50 cents a barrel's intrinsic value, and the rest is time value. Yes?
There's no margin.
Correct. The premium is put up in the full amount. So we see that the premium is 1.93. The strike is 31. The futures are 30.50. So if you bought that put today and then exercised it, you'd be given a short position at $31. You could reverse it at $30.50. So that means that the time value is 50 cents. I'm sorry, the intrinsic value. Intrinsic value is 50 cents, right? So the time value must be $1.43 because intrinsic plus time is equal to the premium. And remember, intrinsic will never be negative. It will either be 0 or positive. Mary? Okay. You're buying the right to sell at 31, okay? And the price today is 30.50, okay? So you can sell short at 31, go short, okay? Today's futures price is 30.50. Okay, so we calculate this as the intrinsic value because if you decided to exercise the option immediately, how much return would that give you in the futures market? Correct. And if it's a put, then you want to take, futures, strike minus futures. And if it's a call, you do it the other way around, right? This is the strike. and this is the futures. Okay, so we say that that contract is in the money because it has intrinsic value. If there's no intrinsic value, it's out of the money. Okay, go ahead. You were going to ask.
The premium. You have to determine that intrinsic value of the premium to the purchase value.
Right. You can always check that because the two should add up to the size of the premium. If they don't, there's something wrong. Okay? Freya.
You can buy a call option and you can buy a put option. If you're referring to writing the put option, selling the put option, you're not talking about buying the put option.
I'm going back and forth. So the question is, am I referring to just writing or just to buying? I've gone back and forth because we're talking about forming the premium, which is determined between the buyer and seller. But in this example, I'm really talking about the buyer, because if you buy the option and you exercise it, then you would obtain a short futures position at the strike. And if you reverse that at the futures price, that's the strike. The clearinghouse gives you a short position at that price. You turn around and immediately reverse it. As the buyer of the option, once you exercise it, now you're in the futures market. You reverse it, you get back 50 cents a barrel. So that's the intrinsic value. Okay? Does that make sense? So the buyer of the option has the right to exercise it or resell it, as we said. If the premium goes from $1.93 to $2.93, well, you could sell the same option and you make $1 there. Or you could exercise it, or you could do nothing. If you exercise it, you obtain a futures position at the strike. And that's how we calculate intrinsic value. The way to calculate intrinsic value is you put yourself in the shoes of the option buyer, and you ask, as an option buyer, if I purchase that option now and immediately exercised it, what sort of return would I get in the futures market? Well, if you get nothing, then it's out of the money. It has no intrinsic value. And the premium is entirely time value. Okay? So that's crude oil. Okay, let's look at a tricky one, which would be Japanese yen. So I don't expect you to remember all the conventions that the Wall Street Journal uses. So on the exam, I'll cut and paste from the Wall Street Journal. But we first have to determine what these prices mean. So let's look at currencies, which is the second column from the right down at the bottom. And you see Japanese yen, Chicago Mercantile Exchange. We've talked about the yen. You know that the size of the contract is 12.5 million yen. And the price is dollars per yen. Now we see the strike prices, and they range from 91.50 to 9400. And again, the Wall Street Journal is saving on ink as they do in the futures page for yen, right? You know that that price is dollars per yen. So if we take the, let's say that first strike, it says 91.50. Okay, so that must be $0.009150 per yen. Remember that right now in the market, the yen is worth a little bit less than 1 cent, correct? Because the yen per dollar is slightly more than 100. So the price has to be a little bit less than 1 cent unless it changes radically between now and the final exam. That's the premium. So I'm just working on the strike for now, okay? This is the strike, yeah, and that gets tricky too, and I'll talk about that in a second for you, yeah. So this is the strike. So the strike, you see, ranges from 91.50 to 9400. Those are always a little bit less than 1 cent per yen. And now the premium, this is where it gets trickier. You see the premium is 1.18. So I'm looking at a December call there. The premium is 1.18 cents per 100 yen. That's how it's reported. 1.18 cents per 100 yen. So if we convert that to dollars per yen, then we have 3 decimal places, 0.000118 dollars per yen. So that would be the premium on that December call. And if we multiply that by 12.5 million yen to get our dollars, because the yens will cancel, we come up with about $1,475. Okay? So, corn is the easiest. It's cents per bushel. We can all multiply through by 5,000. Maybe oil is even easier because the units are 1,000 barrels. But once we get into yen and bonds, the convention gets a little trickier. So it's just a matter of using some common sense, I guess. And you know that when you write down the strike price, it's going to be around 1 cent or a little bit less than 1 cent. And you always put it in dollar terms because you want to multiply the size of the contract by dollars. So you write that down. That's your strike price. And the premium, I mean, if you work out a premium and you're getting $30,000 or $3, something's wrong. But you just have to practice this a few times. And if you look on the old midterm, I'll ask you some, probably on this midterm, I'll ask you some questions on calculating the time value and the intrinsic value. So, I'll put down the Japanese yen prices from here, and I will just choose one at random and say, tell me what the time value is and what the intrinsic value is for the March put with a strike of 91.50. So you have to get used to the convention that they use for reporting the price. So that's currencies. Let's go to T-bonds then. In the case of T-bonds, you'll notice something odd. You'll see that, so now we're at interest rates, right in the center of the page, essentially. Interest rates, Treasury bonds, Chicago Board of Trade. You're familiar with this contract, has a $100,000 face value. And we've been talking about points in 30 seconds, right? But what do you notice here? What does it say? 64ths. So what's going on? Well, the futures prices are always in 30 seconds, but the minimum tick on the options is a little bit lower. So they've just divided it by 2. So the price quotes on the options are in 64ths instead of 30 seconds. So you just divide 31.25 by 2, which gives you $15.62, right? 15.62 for each 64th on the option premium. So that's 31.25 divided by 2. And then let's look at the strike price, and you'll see that the strike prices range from 106 to 107, etc. And they always report the strike in whole numbers, which is nice because then we don't get confused between 30 seconds and 64ths. But again, this is one you have to practice because if I ask you for intrinsic value and time value, I might ask for it in 30 seconds, which means you'd have to convert it. So this strike, it doesn't really matter if it's in 30 seconds or 64ths because it's a whole number. So if we look at the strike, let's choose 107, and the December call, 107, and the December call, that gives us a price of 1-21, or 1 and 21/64. That's the premium, okay? And that should work out to, well, you know that this is 1,000, right? 64/64 is 1,000, so it should be between, it looks like about $1,300, right? 1,328 is the size of the premium. If you see that number, 1 and 21/64, you know that it's somewhere between $1,000 and $2,000. So if you get an answer that's, $25,000, something is wrong here. It's just like when we talked about the T-bond futures. So can anyone tell me if that option is in the money or not? How do we tell if it's in the money? It's a call option. So the call option gives you the right to, what, long or short? Long. Gives you the right to go long at the strike price, okay? So you're buying the right to go long at 107, and the current futures price is over on the right-hand side. Futures is 107. Futures on the Dees contract is 107, 24, 30 seconds. Okay, it's not 64. 30 seconds because that's the futures price. So if you buy the 107 call, is it in the money, at the money, or out of the money? Wonderful. Okay, that's good. It's either out, at, or in, which is good. You're being honest. Okay. Out, in. Just tell me, how do you just think about it conceptually, whether an option's in the money or out of the money? Yeah, go ahead.
Well, the strike price is below the current price, or the December's future price.
Right.
So basically, in order to make money, I mean, you're paying for the option to buy it at 107, right?
Correct.
Maybe
Keep going.
it's in the money.
Okay, did you originally say out?
Yeah.
Okay, well, that's good. See, now you see why it's...
I remember.
All right, so can you just cover that for us again, please? I think some people still not sure.
Okay. So basically, anything above 107 is your profit.
That's right. You're buying the right to go long at the strike price. It's 107. So if the futures price was, 107 and 1/32, well, there's a small intrinsic value there because the clearinghouse gives you a long position at the strike. If you have a long position at the strike, and you could earn a return by reversing that position, then it has intrinsic value. So it's in the money. It's in the money because the futures price is above the strike price, and that we're talking about a call. There's a question here, then back there. Yeah.
What you pay on the premium, cancel out that little, well, I mean, you said like 1/32, it'd still be worth buying. But wouldn't the price you pay on the premium cancel that value out?
Okay. Well, let's. So we know that let's try to answer your question systematically. We know what the premium is. It's $1,300. So tell me this: what is the intrinsic value? $750. How did you get that? 24:30 seconds times 31.25. You don't even need a calculator. Good. Okay, 750. That's the intrinsic value, right? And the time value is then 1328. That must be 578, if my calculator is correct. 578 is the time value. We'll just check those to be sure that's right. Okay. So your question was what?
Doesn't the, well, maybe not so much on this one, I think it's still a little bit more, but like you said, it was like 107 and 132nd. It was still
Yeah.
worth. My question was, doesn't the premium cancel out the profit that you were paying by selling?
So the question is, if the intrinsic value is not equal to the premium, why would you buy it? It's sort of what you're asking, right? Because, yeah, the example I used of 1/32 suggests it has a small intrinsic value, $31 basically. And you're right that that's very tiny compared to the premium. So why does anybody buy such an option? Well, you're paying a lot of time value. In that case, if the intrinsic value is low, you're paying a lot of time value. Here, the time value is $578. And the reason that you would buy such an option is that you think the futures price is going to rise, right? And you think that price is going to go to 110 from 107.24 between now and expiry. That's why you're paying the time value. And clearly, the writer of the option would be a lunatic to sell you options where you could just immediately turn around and exercise them and reverse your futures position and walk home with some money in your pocket. And the writer, there's nothing in it for the writer of the option. Okay? There's a question back here. Okay, so I cleared it up for you? Okay. So which of these, go ahead, sorry.
Exercise the call option now, right? If you wait until the price goes a little higher, then how much will cover the premium?
So the question is, would the buyer exercise the option now? Well, probably not if you just bought it this morning. But you know, if you've held this option for a while and you've been expecting T-bonds to rise, excuse me, you might look at this situation and you say, well, I'm going to cut my losses and grab what's left of the intrinsic value, and I'm going to take $750 out of this contract. So it's possible that they could exercise it and get some of the intrinsic value back. It really depends on their motivation. They're cutting their losses if they do. Okay? And as you approach expiry, then the time value starts to erode, and you know, you could also sell it. You could sell the option in the market because there's still a significant time value here. And every day, this is a December contract, right? I mean, this time value is going to drop like a lead balloon because as we get, you know, within 3, 4, 5 days of expiry, that time value just goes to zero. Yes?
So you don't have to exercise an option at exactly the strike price. Like if you have you want to buy, if you have the option to buy at 107, you can buy it at 108.
No.
You have to exercise at 107.
Right. So the question is, if you exercise the option, what do you exercise it at? If you exercise the option, the way it works is basically you call the clearinghouse and say, I'm holding this option on a D's contract with a 107 strike. I'm exercising it today. And they say, fine. And they assign you a long futures position at the strike. So you're assigned, you're now in the futures market. Okay, that's how it works. If you exercise the option, you've put yourself in the futures market at the strike price. So they assign you a long position at 107, and you know the way the clearinghouse works, if they're giving you a long position at 107, what do they do with the other side of that position? Yeah. Somebody who wrote the same option will be assigned a short futures position at 107. So the writer of the option, after you make your phone call, the writer of the option receives a phone call, probably an email these days, receives notice that they're now in the futures market and they have a short position at 107. They're short at 107, the price is 107.24, so you know they're underwater on their futures position, right? Okay. I thought I saw a hand over here somewhere.
Do a lot of people exercise the options, or is it more like they just hold it for trading?
Question is, do a lot of people exercise the option or resell it? I mean, it really depends on the market. It depends which way the market's going. You know, obviously, if they become extremely valuable, then you'd find more people exercising. And whether they exercise versus selling it, you know, that's just a question of a few dollars in transactions cost. And if the market goes against them, well then, you know, it's for the fireplace, right?
The sellers deal with the risk of having the buyers exercise.
I'm sorry?
How do sellers deal with the risk of having the buyers exercise the option?
How do sellers deal with the risk of buyers having, yeah. Yeah. There's a sort of an advanced course that we could have on options that would discuss ways that writers of the option could reduce their risk. If I just call my broker this morning and ask the broker to sell some crude oil options, and I don't have any underlying futures contracts, then that's referred to as writing a naked option, where I'm just selling the options and I have nothing to cover it with. So they're uncovered. And that's really the example I'm using here because it's the simplest. But what you're asking is, you know, in the markets, there are some very sophisticated writers who will hold underlying positions. They'll hold complicated portfolios. So if they're writing options, they may not be fully exposed to that adverse price change. You know, they may hold some crude oil or some other instruments. So it really depends. So they can, you know, diversify their risk as well. But basically, once you've written the option, then it's the buyer's discretion. You know, if the buyer decides to exercise it, there's nothing you can do once you've written it. So for the writer, the risks are much higher than for the buyer. That's why we said they're asymmetric. Okay, some of you weren't sure if this was at the money or out of the money. Can you give me an example of a crude oil? We're looking at we're looking at T-bonds here. Can you give me an example of a T-bond call option that's out of the money? 108. Okay, perfect. Right. The futures price is below that strike. So if you bought that option and exercised it, and you're long at 108, well, the price is below 108, so there's no way you can reverse that futures position and earn a return. So the intrinsic value there is 0. So if we look at the 108 price, that's 48.64. The intrinsic value is 0. That's entirely time value. That premium is entirely time value. There are some examples on last year's midterm where I always ask you 3 or 4 questions, time value, intrinsic value. And it's really a matter of practicing. You can sit here and listen to me and think you understand it, but you really need to work through some examples. And just use the Wall Street Journal this week because that's what I'll be using as the current page. So I think we've done a pretty good job of going through these. You can practice some others as well. Maybe have a look at the euro dollar, and we can talk about that on Monday.